Very good afternoon to all of you to this seminar on Bank Audit. First, thanks to all the participants for the overwhelming response we had yesterday. And I have today with me CA Gyan Prakash Gupta, who is the President of Kanpur Chartered Accountants Society. And I have Akshay Gupta ji, who is going to chair the session. And of course, the eminent speaker, Shri Anil K. Saxena, who is going to do the deliberations. So I hand over the proceedings first to the President KCS, Gyan Prakash Gupta, who is now basically organizing this seminar and has been the host and has been kind enough to offer all the facilities of Kanpur Chartered Accountants to us members. Over to Gyan.
Thank you, sir. I welcome respected Akshay Bhaiya, Anil sir, Manu Bhaiya, and thank to Manu Bhaiya to organize webinar on bank audit for us, for members, and I also welcome to all the members who have already joined us. Thank you. Over to Manu Bhaiya.
Thank you, Gyan, and once again welcoming all members. A very good afternoon to Akshay Bhai, to Anil Bhai, and basically we are starting off on the part 2 of our bank branch audit presentation, and today is, I think, the key day where all the IREC norms would be discussed by Anil Bhai. We'll be having this session from now up till 4:30, and post 4:30 we will have the question answer session. You can keep sending your questions as you sent yesterday. We will be having those questions. Probably Anil Bhai will break in between somewhere where one chapter is over, and then he'll take questions up to that point at that very time, and then you can ask afterwards also. So now for starting, over to Akshay Bhai.
Thank you, Manu. We must thank Anil, and I welcome all the participants. Special thanks to Anil. I witnessed and you all witnessed his deliberations yesterday. So far the bank audit is concerned, probably none of us has taken it so seriously or so thoroughly, I should say. As Anil narrated yesterday, he told us many new checks, many new sources where from the information can be gathered. For example, he told us about the red flag accounts, he told us about the exceptions reports, he told us about the credit reports, etc. Whereby we can, by using these sources, we can assess the risk, we can plan our audit procedures, and of course, one very important thing which he told us yesterday in the whole process, to document each and every audit procedure which is performed. May it be your meeting with your articles, may it be your meeting with the bank management, and may it be the collection of data and so on and so on. So that is becoming very, very important leg of the audit. Just for the sake of repeat, I am saying so because what I am seeing sometimes when I am representing or I am advising some of my colleagues, members on whom some proceedings have been started, that they are lacking. Of course, even after doing all the audit procedures, they are lacking to provide the documentary proof of the evidence that they have performed the audit procedure. So that is very, very important. Now today, the very, very important aspects of the bank audit. As I discussed with Anil, today we will start with, first of all, the regulatory changes during the year, which are applicable, or which will be applicable to the bank branch audits, the balance sheet, the profit and loss account, the capital adequacy. Of course, capital adequacy, there is not much at the branch level, but Anil is very sure there are certain aspects, certain issues which all the auditors should keep in mind. And after that, the IREC norms. And if the time permits, IREC norms, we will if not, we are not able to finish it today, then of course we will continue IREC norms for tomorrow also. And with this, Anil, I invite you to come out with your presentation. Please share your screen.
Anil bhai, you are on mute.
You are on mute, Anil.
Okay, now okay. I have unmuted you. Anil bhai, you can proceed.
No, but my presentation I think is
Ah,
not
sir,
being.
sir, you start your presentation is coming in
Okay.
10 seconds. You just,
Whenever you will
Okay.
share it.
Uh, I've already shared it.
no, no,
Good
it's coming,
afternoon.
sir.
Okay. Good afternoon, friends. I think post the discussion we had yesterday regarding documentation, planning, etc. I think now we get on to the other jobs in respect of bank audit. Obviously, what we discussed yesterday was all about most of it about off-site planning and also on-site planning. What are the kind of documents we need to take during the course of the audit, and kind of go as per the procedures which the institute has set out for us as per the standards on auditing, etc. Friends, I think this is the agenda I've set out for today. Number one, the all important regulatory changes which have happened during the year. Some special checks for the balance sheet and profit loss account. Not too much to say on the audit report, LFR certificates, but even then, whatever we can share with you, I'll definitely share with you. Like Akshay Bhai said, that in my opinion, I think capital adequacy has a lot to do. We can do a lot when we come to checking the CRAR statement, as it is said at the branch level. So I've listed a few checks which we can do, which we need to carry out with respect to the capital adequacy at the branch level. And if time permits, then definitely we get on to the IREC norms. I think, see, there have been many changes during the year. The large exposure framework, I'll of course be taking up when I take up the IREC norms. There's one important change which happened after the 12th February 2018 circular got struck off by the Supreme Court. So then the RBI came out with a new prudential framework for the resolution of stressed assets, dated 7 June 2019. I'm not sure, based on the kind of the audience I have as of yesterday. I think this is one circular, since it applies as of date mostly to accounts with exposures of more than 1500 crores. Then maybe it will be more of an information. And of course, I'll run through the slides, in fact, just to keep it in record for people who are interested. And then subsequently, in case there's anything to be discussed on this circular, I think people can call me up anytime to discuss this circular. Then there is, a very important circular which was in line with the circular which came out also in 2019, which was respect to the restructuring of MSME advances. It's the 11th February 2020 circular is more of a extension of the earlier circular. So, it's not a very large circular because it takes most of its content from the circular of January 19. And then very recently, post the COVID disruptions, which the RBI has come out with the circular of 27th March 2020, which of course has some issues which probably I think would get clarified by the time we start the branch audit. Now, let's start off from the reverse, like, let's start off with the 27th March 2020 circular. What are the changes here? Now, there are two changes. What I've done in this is primarily the entire circular I've copy pasted. It's not as if, I've only taken the bullet points, but primarily converted the circular into bullet points. Now, this 27 March 2020 circular talks of a moratorium when it comes to the term loans and a deferment when it comes to the CCOD accounts. So, in respect of all term loans, literally, it's it covers all the term loans which are there. Like if you see at the bottom, it relates to principal interest components of all the loans, the bullet repayments, the EMI, and even the credit card dues. And even with respect to the banks, it's covering all banks, including RRB, small finance banks, etc. So what it goes on to say is that the circular gives a moratorium of 3 months on payment of all installments between 1st March to 31st May 2020. Effectively, that means moratorium would mean that I have a holiday for that period, and it does not get one needs to imagine as if the installment was not due during this period. Now that means March, April, and May. I mean, these are the three installments which the RBI has given a moratorium. Now, this 3 months, of course, the circular goes on to say that these 3 months, the repayment schedule would get shifted after the moratorium period. And however, the from the bank's angle, the interest shall continue to accrue, and obviously that means it doesn't become due, but then on the income side, I do take it on the as income for the bank. Now, the issue which comes out in this is, as of, if you see the para 2.1.3 of the RBI Master Circular of July 1, 2015, now that actually says that, the principal and the installment is to be received within 90 days, or else it's an NPA. So, when we were doing the audit of March 19, because that was not a leap year. So last year, what happened was that anything which even if the principal and interest of any term loan had not been recovered up to 31st March 2019, then because as per the para 2.1.3, it did not fall in that. It did not become an NPA. It became an NPA on 1st April 2019. Now, during this year, this being a leap year, effectively what it would mean is that any principal or interest which is due as of 31st December 2019, now that if it is not recovered up to 31st March 2020, it will still be an NPA, because the moratorium given by the RBI or by this circular is only in respect of installments which are due on between 1st March 2020 to 31st May 2020. So this is something I think sooner or later the RBI would need to clarify, because in case we are recognizing that the COVID has disrupted the cash flow of the individuals and the other business houses, and they would not be able to pay. So obviously, in the normal course of business, any borrower, he had time up to the 31st March 2020 to pay. So this is one issue I think all of us need to keep in mind, that installments due up to all payments due up to 31st December 2019, to my mind and my in my viewpoint, it would become a NPA as of 31st March 2020 if it is not recovered in spite of the 27th March 2020. Now, when we get on to the CCOD part, now whereas when we see the circular with respect to term loan, it uses the word moratorium, but here it uses the word deferment. So what here it, because there it gave a moratorium for 3 months and shifted the entire block of those 3 months interest and installment to the end of the installment. So probably if I had another 60 months left for the term loan to be repaid, now as of date I would have the 60 plus another 3 months, because that gets shifted subsequently. Of course, the EMIs etc. would be adjusted. But when it comes to the working capital facility, what the circular says is, I defer the recovery of interest, although I keep accruing it. So, if you look at the statement of account of any CCOD borrower, probably you'll have the interest being shown as being debited even on March, maybe on 27 March, 26 March, depending on the bank you're doing. But then it gets debited there, but in respect of the recovery, it is not to be recovered, and it is deferred for the period after 31st May 2020. That is what the circular says. So now, what is the issue which probably one can think of in this? Now, this issue is when you go to the IRAC norms, which we'll also discuss subsequently. There are three conditions of an account becoming an out of order in CCOD and consequently being classified as an NPA. One of the condition is that if the credits during that period are not enough to cover the interest debited, right? So let's imagine a scenario where okay, I have accepted as per the 27th March that the March circular, in spite of being debited, it is not to be recovered. It is deferred. Hence, what happens to a case where the recoveries in that account from 1st of January 2020 to 31st March 2020 are less than the interest debited during January and February, because the period is complete. March, I'm assuming the interest is not to be recovered, but then the credits need to be enough to cover at least the interest debited during January and February. Obviously, if you actually imagine a CCOD account where the credits are not even enough to cover the interest debited during the first 2 months, obviously there as an auditor, the first thing which would come to mind is there is an inherent weakness, and there is something wrong. So that is the second issue, where I think unless the RBI clarifies that even the dispensation of the such accounts being classified as NPA, of course, that will be there. Then, of course, there is news coming around that the RBI could extend the delinquency period from 90 to 180 or maybe 270. So that's something which probably we'll have to wait and watch and see what would be done. So as the circular clarifies, the interest has to be recovered immediately after the completion of the period. So that means post June, I would need to recover this. Another thing which the circular goes on to say is that in case of the CCOD accounts, banks, if they feel that the because of the COVID-19, there could be some businesses where the business has taken a deep impact on account of the COVID disruption. Then what the RBI circular says is that you may recalculate the drawing bar, and or either reassess the working capital cycle. But then this has to be done up to the 31st of May 2020, and one needs to ensure that the drawing par reduction of margin and reassessment of the working capital is only on account of the economic fallout which happens because of the COVID. I mean, this circular, borrowers or the banks should not take shelter and start recalculating the reducing the margin and reassessing the working capital based on this circular. So it has to happen. As auditors, what I would or we would need to do is we would actually need to see when is the turnover actually going down. So is it post the maybe the COVID which happened probably the 21st of March? Is it post that, or was the account under stress even earlier? If the account was under stress earlier also, then it would be difficult for us to actually give relief under this package, because the circular also says that the banks would be subject to subsequent supervisory review with respect to the justification of giving relief under this. So as auditors, I think the best document which we could probably have is maybe the GST returns for the past 6 months. Try and review what is the kind of turnover the borrower had, and did the turnover take a sudden hit post COVID. So that is one thing which we as auditors would need to do. Of course, it clarifies that uh, there would be no class asset classification downgrade, because any concession which we give as per the master circular, and also various other clarifications which the RBI has given on instances, that except for one or two instances where you can retain the asset category of an account, I need to downgrade the account as soon as I give any kind of concession, which would be which would fall within the definition of restructuring. So, if I'm giving a moratorium, a deferment, a recalculation of DP, normal course, this would be a restructuring. But then the circular says that this would not result in a asset classification downgrade. That means I retain the asset classification in spite of giving these concessions. Uh, of course, I think this is further clarification on this. Then one very important clarification which the circular gives is that this rescheduling or deferment or anything which we are doing, this should not result in adversely impacting the credit history of the borrower, and as a result, the downgrade in the rating of the borrower by the CICs. So I think this is a guidance by the RBI to the credit information companies, that you do not downgrade such accounts just because of the circular, where it does not require to pay, or the interest is deferred, or any other relief which this circular gives out. Of course, it does talk of forming board-approved policies, and one thing which it talks of is, which probably would help us as auditors, at least with respect to accounts where the exposure of the borrower is more than 5 crores. The circular talks of the bank developing an MIS, where you have information with respect to the borrower wise, credit facility wise, regarding the reliefs granted to such accounts. So probably at least in respect of all accounts of 5 crore and above, we would have this information with us. We can seek information from the banks with respect to the MIS developed by them. So this was about the circular which came out on the 27th of March. And then another important circular which would probably be applicable to most of us, whether we're doing small branches or big branches, is a circular which came out on the 11th February. Like I said, it is an extension of the circular which came out in 2019. It has a few conditions. It primarily says if it is an MSME, I can do a one-time structuring without a downgrade, which is again an exception to the normal rule that if you restructure, you downgrade. This particular MSME, not only this year, but even the previous year, it had one or two challenges. One challenge was, one of the condition is that the fund-based, non-fund exposure from banks and NBFCs has to be less than 25 crores as at 1st January 20, and the earlier one, I think it said 1st January 2019. Now, as an auditor, ensuring the compliance of this particular condition, because, based on my experience, I have not seen any document which the banks hold where they're able to prove that the exposure is less than or equal to 25 crores as of the cutoff date. Now that is one challenge which as auditors we would face, as to how do we ensure this. In a corporate, maybe even the maximum you would probably do is you would get the financials downloaded from MCA of 31st March 19, get that information, but then that is no guarantee that the exposure would not have gone up beyond that as of 1st January 20. So this will be one challenge. The second challenge is, how do we ensure it is an MSME account? Because this particular circular is applicable only to MSME advances. Now, none of the banks, of course, unless some banks have started doing it, none of the banks actually have that MSME registration number anywhere in their parameters. So if probably all they do is they probably only say this is MSME. Now that MSME flag which they mark off is normally based on the guidance which is there on the Udyog Bandhu site. Which are the accounts which are which can be registered as an MSME. So that's about all. But then as again this would have a challenge that whether banks are actually taking shelter of this circular to restructure all accounts, retain the asset classification, and do away with only providing for 5%, as compared to probably if they had to classify that account as an NPA, providing for 15%, which would have been a challenge. So these are two big challenges, which it's a very difficult task. I've tried it myself also. The best I can advise all of you is do carry out all steps where you're able to satisfy yourself about the exposure and whether or not these accounts are MSME. And another thing which obviously you can do is, based on the kind of business the borrower is doing, compare it with the of course, like I said yesterday, other than the circulars which you refer to from the RBI website, you also need to, for an easier understanding, refer to the FAQs which are available. And there is an FAQ available with respect to MSME. So what you can do is you can download that. I mean, it also lists out, which are the industries which are where MSME would be applicable. So probably what you can do is you can try and find out, the accounts which have been restructured by the branch you have gone in, look at the kind of business they're doing, and then map it to the eligible business which can be categorized or registered as an MSME. So those are a few steps which you can take, and of course seek confirmation from the bank or the branch management. But like I said yesterday, the MRL under the SA 580 can never be a confirmation of anything. I mean, the unless the audit steps you carry out are sufficient, just taking an MRL and thinking that I've done my job, I don't think that would stand the test of times. Of course, in this particular case, now it says is, these three conditions, like, the fund based is less than 25 crores. It is, the account obviously would be in default, but it is standard as of 1st January 2020, and it continues to be standard up to the date of implementation, and it is GST registered unless exempt. So these are the three basic conditions which you need to, those MSME accounts need to have, so that which would allow the banks to restructure that and retain the standard asset category. Now, the implementation in the earlier circular of last year, that got extended up to the 31st March 2020. Now, here it gives you an option of implementing it up on or before 31st December 2020. So obviously, what is implementation? That, I have completed all the formalities which are required to be done with respect to restructuring, including, the documentation, the security, creation of the security charge, perfection of securities, etc., etc. Now, so these are the three conditions which, but then see, the second condition talks of the account being in default but standard, and it needs to continue to be standard up to the date of implementation. So in case I carry on with the account, I have the application, I say it is being restructured, but it is not implemented up to 31st March 2020 when you go, or maybe even up to the time you visit the branch in maybe May or June, whenever this lockdown gets lifted. So what I would need to confirm is that it remains standard up to that date, to ensure that the restructuring process is in line with the circular of 11th February 2020. This circular also talks of, in respect of all such accounts, a provision of 5% needs to be made, all in addition to the provision already held, because it also talks of the restructuring being allowed for NP accounts. So but this 5% provision which is to be held in addition to the provision. So if it's a standard account which we've restructured just in default for 1 or 2 months, and then I restructure it and then finally implement it before 31st December 20. So this provision of 5%, I can reverse. The circular goes on to say, provided there are conditions that neither the term loan, the principal interest, and the overdue in the CCOD account ever exceeds 5%, 30 days. So in case I'm able to during the course of the review period, I'm able to have an account where in spite of the period for classification as NPA being 90 days, that particular account is able to service the interest and principal within 30 days, then the RBI circular says that this provision of 5% which we had asked for can be reversed. Now, but then again, this is something which probably is more theoretical than would ever be practical, because can you imagine an account which is actually in default or in stress, and where you are restructuring that account, and then you expect that account to be servicing the interest and principal within the 30 days of the due period, which if it does happen, of course, in all such accounts, the banks do get a option of reversing this uh, extra provision. Post restructuring, of course, the NPA classification would go on as per the normal IRAC norms, which we would discuss subsequently. And accounts to be classified as NPA can be restructured. So, here again, this MSME circular does not, remove, carve out NPA accounts from being restructured. We can do it, but then, the asset classification, age-wise delinquency would continue to apply. And like I said, these accounts, they have the option to reverse the 5% provision, provided it displays satisfactory performance during the specified period. The MSME and other accounts to which this RBI circular of the earlier one, that is 1st January 19, is not applicable, then such accounts will be required to be downgraded on restructuring. That is, normal restructuring norms as per July 1, 2015, read with other subsequent circulars, would apply. So this satisfactory performance primarily says that during this period, no payment is overdue for a period of more than 30 days, and in case of CCOD, the sanction limit drawing power is not in excess for a period of more than 30 days. For a year in that case, if it does happen, then I have an option of reversing the 5%. One clarification again, is that the accounts which have already been restructured in terms of the earlier circular I was referring to, the 1st January 2019 circular, they would be ineligible for restructuring under the circular. Friends, I think, whenever you read this 12 February 2020 circular, please read it together with the 1st January 2019 circular, because, most of the contents of the circular are in the 1st January 2019. The 2020 circular is only an extension and not a circular in total. So this was this was the second circular, which I think would apply to most of us. So to summarize, I think we would have two circulars: one, the 27th March 2020 circular, and the next one would be the MSME restructuring circular. Now, this I would not, like I said, take up, but I'll just broadly tell you the guidelines, because this is only in respect of accounts with exposures of more than 1,500 crores. It came about only after the Supreme Court struck off the revised framework of 12,000 February 2018. If you remember, 2018 February circular, actually resulted in the gross NPAs across the banking industry going up substantially, and the bottom line of all the banks taking a deep hit during that year. Like if you the earlier circular of 2018 primarily talked of taking the borrowers to IBC immediately. But now, what this particular circular of 7 June 2019, primarily what it says that you carry out a resolution plan, and the resolution plan is open to the banks deciding upon it. So if you see the reference date for less than 1,500 crores is yet to be announced. So this circular primarily, if you see this slide, it says that if you are not able to take out a resolution plan within 180 days, together with the review period, which is 30, then all you need to do is have an additional provision of 20%. And if you are still not able to do it within 365, the bank provision takes a hit by another 15%. So a total provision of 35% would be required, together with whatever the asset classification of that account is. So primarily what it tries to do is it forces the bank, unless they want to take a hit on the bottom line, and of course it would be subject to the supervisory review, that you provide for the extra 20 or 15% in case you do not come out with a resolution plan. Uh, there are some conditions for upgrade, of course. This you can actually download the 7 June 2019 circular and do that. Akshay, would you say that because these are two important circulars, do we take questions, or do I go on up to the capital adequacy and then take questions?
I think we can take questions on MSME at least.
Yeah, I think we can, Manu. We can take questions for around 5 or 10 minutes, and then
Okay, sir. We have very few questions, so
Okay,
I'll quickly run you through them. Um, we start from the first. Just a second, sir. There's a question asking for the audit program, which I think you'll provide post the session or something like that.
It's not a question.
it's not a
It's
question.
it's a request. uh, and just a second, sir. I'm coming to the
Acha,
first question. And another request, which I think you already mentioned, can you please include bank audit by Excel tools? So you basically said on the last day, if you could show some practical tips, tools, how to do it, then you'll do that on
correct,
the last day. So this was
correct,
from Kuldeep from Mathura,
correct.
his question. So that's taken care of. And then we have, I think, Rajesh ji from Dhanbad, who has asked a question. If I'm correct, he's from Dhanbad. Um, His exposure
No,
means the sanction limit on and or
Rajesh,
all outs.
Rajesh ji, generally exposure, whenever used, of course you'll have to check the specific circulars you're referring to, but then generally exposure would be fund-based and non-fund based exposure of the particular borrower. So it would have nothing to do with the sanction limit, definitely. But all you need to ensure is that whether the non-fund based exposure is also to be included in that. Generally it is, but then I would not comment on it unless you tell me which particular circular you are referring to. Vitesh ji, I think MSME registration. Vitesh ji is from Bombay.
Ah,
I think the question is. I think to my mind, at least if MSME registration is not compulsory, but at least one thing is compulsory, that the particular business which the borrower is doing should be eligible for being registered as an MSME, because normally MSME registration is only a 2 or 3 hours job. So I mean, that's not the issue. The issue is whether the business which the borrower is doing is eligible to be registered as an MSME. So obviously, then the bank can take shelter of that loan. The MRL, next question.
MRL, sir, that was the question. What is
On,
the full form of MRL?
okay, MRL is the management representation letter which all of us as auditors need to take across any audit assurance job you do as per the standards on auditing 580. Maybe you want to say, or bank's identity MSME classification to be considered. I think Vitesh ji, I think that is something which obviously, as of date, I think all of us have been doing from 1st January 19, that accepting whatever the classification by the banks. But then, as an auditor, I think I think you have also been doing, and take a sample of the restructured, then map their business with the MSME eligible business, and then talk to the banks concerned.
Anil, I will like to add here. So
Yes,
far,
sir.
this information is concerned. What just now Vitesh has asked. Uh, you see, this is relating to the restructured accounts only, and
Yes, sir.
restructuring is never done suo moto by the banks. It is based on certain application, and then only the restructuring can be done. Some of the banks, as I know, we discussed it earlier also, they in this restructuring application they took declarations and about the parameters of eligible for MSME. And of course, in our course of audit, if there is no such declaration, on selective basis, we can ask the branch management to take at least some declaration regarding these parameters uh, in some of the accounts on sample basis. And in some cases, a CA certificate have also been taken on our request by the branch management and of course the regional office, etc. And then we could verify, satisfy ourselves about their eligibility. Some kind of system, central statutory auditors can guide their bank management to built in their restructuring application process.
Correct, correct. Now, how to get information for restructuring? Earlier here, Pawan Tiwari ji is asking. I think, Pawan ji, most of the banks, they have in the data an MSME flag, or you can ask for all accounts which were restructured, sorry, the restructured flag. So, when you review any account, you would, in Finacle, you can find out whether they have been restructured or not. Sanjay Agarwal, whether trading firms are covered in MSME or priority sector. Sanjay, I think, priority sector is a separate question, but MSME, I think, you'll have to check the exact business. But then, to my mind, MSME they would be eligible to the MSME registration, even the trading firms. Sanjay says, as banks are showing trading firms as priority sector, and says computer is plant and machinery and condition of MSME is fulfilled. Exactly. I think, there is no ban on, even in the Udyog Bandhan website, that, even if you're a very small trader and probably you only have a weighing machine, even that, and if you're probably a general merchant, if you have a look, I think, they are probably also eligible to be registered. But of course, I'm not an expert in this, but I think you need to take a look. Prashant ji, you're talking of ad hoc sanction. Let's take it up in the IRAC session. We are currently restricted to the changes during the year. Yeah, Sanjay, there is a FAQ available on the RBI website, rbi.org.in. You can, on specifically on MSMEs, you can download that and have a look, and then ensure through the index on the available on the RBI website whether or not there are further any change. Sukant from Varanasi, I think if MSME criteria is fulfilling but the entity is not registered in GST, obviously if it is not exempt, then it would not fulfill the three conditions for which it is required as per the February 2020 circular. Manu, should we carry on with this? Because I think we can.
Probably next, just two, three more questions if you want to
Okay.
complete them.
Whether COVID-19 circular affects income recognition of interest of March 19, with respect to term loan, it only says there is a moratorium. So, it is out. Moratorium means, it is a holiday period. Obviously, you will not take that. And in term loans, like I said, if you read the master circular, para 2.1.3, it has no, it would not be relevant that, whether January, February, March installments have been received or not. Even in an account where January, February, March installments principal have not been recovered, they cannot be classified as an NPA, any term loan in the normal course, even if COVID had not happened. Praveen ji is asking, the account was restructured by the bank when the account was actually NPA as on date of restructuring, but the bank had not classified the account as NPA. What should be done? Then obviously, if you're passing an MOC, then you take the actual date of NPA, and as the February 2020 circular says, you are allowed to restructure NPA accounts, but the normal asset classification norms would continue to apply on such accounts.
So, Anil bhai, I think that's it for right now. So, you may please proceed.
Right. Uh, I think now we'll get on to some statements which normally it is not the senior, like when we were discussing the planning part yesterday. Manu, can you mute the others? I'm getting voice. Yeah, thank you. Balance sheet profit loss account, normally I would not again generalize. I'm not saying that all of us do it, but I have talked to a few people, and then generally they believe that the balance sheet profit loss and other statements which are generated with respect to the financial statements are generally, the audit checks would generally be limited to mapping it with the respective CBS software. My checks are primarily to ensure that there can be a number of issues which we can pick up from the balance sheet and profit loss, and ensure a good quality audit. Now, on a macro level, you would see that a branch audit, except for the second bullet, or you would generally be doing it. You would be certifying a host of certificates. Like I said yesterday, please ensure that you sign and certify only those certificates for which you have the appointment letter and for which you will exchange the engagement letter. And then, of course, the LFR, the profit loss balance sheet, together with all the statements and the advances. So on a very macro level, I think these are the things which we do whenever we plan for a bank branch audit. On the liability side, if you see that generally in a branch of average size, I think what would be important is only the fourth bullet and the last bullet, that is the contra items, the off balance sheet items, which to my mind are very, very important, because they would not only be probably overstated, but then it would also have a huge impact on the capital adequacy statement which you're signing. And then, of course, the other liabilities, where and if you took a look at the asset side, similarly, advances, we've already obviously all the auditors lay a lot of importance to the advances side. But then the other things which are left would be just two broad heads. That is again the off balance sheet items, which would be the contra to the liability side, and then the other assets. So if I try and summarize that, in a balance sheet, what exactly do I do? I actually concentrate on the advances portion. I concentrate on the contra items, the off balance sheet, the assets and liabilities, and then I'm left with two broad heads where, everything where they do not get parked in these accounts can be parked is the other assets and the other liabilities. So I think, we need to concentrate on these two heads, the other assets and the other liabilities. Let's get on to some special checks. I think, like any financial statement, I think the first step which we all of us need to do is, some of the banks, in fact, have a comparative already as part of this thing. But then, you do a year-on-year analysis of both the balance sheet and the profit loss. Try and highlight which are the abnormal variances. Ask your article assistant, or whichever audit resource is doing that, to bring to you all abnormal variances which are there in the balance sheet and the profit loss, so that you can concentrate on them and try and see whether you have justification. Again, like we said yesterday, wherever there are abnormal variances, one needs to document that in an Excel file to finally say that this was the reason why there was an abnormal variance. Now we come to the bank guarantees. Now the bank guarantees is something. There are two steps, I think, which we need to take. Number one, obviously, whenever you go to any branch, you find that there are a number of BGs and LCs. You take a list of them, find out which are the bank guarantees and the LCs which have expired, and which are the ones I need to knock off. I do not knock off anything which is obviously just the year end, but I need to knock off those bank guarantees where the claim period has expired, and also after the service notice. So you need what you need to do is, at least in a selected sample where they have expired, and if the bank guarantee amount is material, ask the bank to give you the bank guarantee bond. Please read that and then see what is the claim period with respect to that bank guarantee bond. Now, when you have the bank guarantee bond, why I wanted you to pick up the bank guarantee bond is, the first thing which I need to do is, I need to first check whether it's a performance or a financial bank guarantee, because that is the biggest problem in most BGs which are there in a branch. Yeah, if an incorrect classification of performance of financial bank guarantee happens, two things would happen. See, if it's suppose a financial bank guarantee, I obviously have a higher commission. I'm not saying most branches would do it, but there would be an incentive for some banks, some branches, some branch officials to classify an account irrespective of the nature of the bank guarantee into a financial bank guarantee, primarily because I have a higher commission. But the downside of that is, if I because of the commission, I classify an account as a bank guarantee as a financial bank guarantee, I take a hit on the capital adequacy, because the risk weight on a financial bank guarantee is higher as compared to a performance bank guarantee. So that is the reason why, when you take up the audit of the off balance sheet or the contra items, I mean, this is the bank guarantee review is a very important review, and the classification as per the RBI circular, which I've given to you here, the 2nd April 2013. In fact, if you go into that circular, there is a table there which actually lists out, which are the guarantees which are to be classified in a performance bank guarantee and which into a financial bank guarantee. So if once you do that, not only do you change the classification of the bank guarantees in the financial statements, but you also correct the capital adequacy statement because of the change in the risk weights of both the performance and the financial bank guarantee. Now, broadly, the financial bank guarantee, of course, the examples are there in the 2nd April 13. But if you actually go as per the thumb rule, financial bank guarantee is primarily where the bank assures payment of money, and performance, like the word says, basically the timely and the adequate performance of a contract. That would be a performance guarantee. So once you're done with that, I think you've done two statements. One, the classification, and the other is the capital adequacy. Of course, normally the interest receivable and the interest payable gets parked in the interest receivable account gets parked under the other asset side. The interest payable account gets parked on the other liability side. Most, in fact, I would say, if not all, account banks, have this through the Finical. So not you would only have to probably test check to find out whether all accounts which are performing, the interest receivable portion has been debited and held under the other assets. So what one would require is that the other assets, when I take up each line item and try and find out what is the nature of each account, and if I find an interest receivable account there, that obviously that would mean that these are the accounts where the system, the CBS software, has parked the interest from the period on which the actual debit has happened in the borrower's account till the year end in the other assets and credited the income. Similarly, in the deposit side, I would have the interest payable. If you check, except for maybe a few banks where they have started debiting the interest on the CCOD, etc., on the last date. Many banks, they continue to park, debit the interest in CCOD accounts on dates probably a few days earlier than the year end, to avoid the load on the central server. So this is the period for which I have the interest receivable under the other assets, and similarly on the fixed deposit side, I have the other liabilities. So I, as an audit exercise, I ask the bank, or probably you may find that these are the reports which are probably parked in a separate report folder on the site, the intra bank site, and you may need to download, or you may probably need to ask from the zonal manager or the regional manager, the branch manager, to give you the details, because without these details you would have two line items where you do not have the individual account wise detail. And if I do not have the individual account wise details, obviously my audit exercise would not be complete. And then another very important check, I think, which we all need to do is, a very broad thumb rule is, any FITL account if I have, I need to generally, match both the arms. That is the FITL under the other advances and the FITL under the other liabilities. FITL, just for the help of people who do not understand that, any account which is restructured, and if interest is not is overdue, generally the banks would convert that overdue interest portion into an FITL account, park it under advances, and reverse that income by debiting the income head and crediting other liabilities in a FITL. So that is why when you actually start scrutinizing the FITL account under the other liabilities or the other liabilities head, you may find an account which relates to FITL. So that obviously would mean that there are some FITL accounts on the advances side. So you go by the thumb rule exercise, try and map both the arms, and if both the arms map, you're done with the job. And if they do not, then obviously it would indicate one or two things. Number one, over the period from the time the FITL was created, and if I have recovered some amount, reduce the FITL debit balance, but not recognize the income by debiting the FITL under the other liabilities and crediting income, I would have a mismatch. So in case there is a mismatch, what you would need to do is go back. Sometimes I have actually identified cases where probably this exercise has not been done for 1 or 2 years, or probably 3 years. and you may find that you may need to pass an MOC for an amount which probably relates to earlier periods also. So one exercise would be to do this. And secondly, please remember that this mapping of both the arms of the FITL is generally not a CBS exercise. So generally it is manual in many banks. So this would, as part of the audit exercise, you would require to do this by mapping both the other assets and the other liabilities, FITL related line items. And other than this, other than these two broad heads, to my mind, what you need to do is, ask for details of all material other assets line items and separately other liabilities also, and then try and see if there is anything which should not have been parked on overheads and which should probably have gone to the income expenditure or probably some other head in the sheet on the asset side of the line item. External information procedure, like we talked of, we obviously would need to do with respect to all the bank, the advances, the deposits on the liability side, and any other balance which you feel an external confirmation procedure is required to be done. Now, when we come to the profit loss, if you see, the income side has only three broad heads: the interest earned, commission and discount. Commission discount, I would presume that based on the in case the branch is under concurrent audit, obviously the commission discount would get test checked. But as an audit exercise, you can definitely ask your audit resources to do a test check of the commission discount, but definitely put a lot of stress on the interest earned portion, because that, if you see the total of the income side, the interest earned would be a major portion of the credit side. Similarly, the expenses part, if you see, the sundry charges would not be substantial, but even then, exercise, the audit normal exercise of preparing a lead sheet, if possible, would be required to be done by your audit resource. And of course, in a profit loss of a bank, the interest paid and the interest income, typical to its the nature of the business which banks do, would be the highest. Here again, we do a ratio analysis like we talked of in the balance sheet. Uh, I think, when we talk of the interest income, primarily we would think of mapping it to the sanction letter and to various heads which we'll talk of. There are a number of risks which we need to mitigate as auditors when we talk of the verification of the interest income part. The interest expenditure part, of course, should also be subject to the an audit procedure, a test procedure. But I think the interest income would be more prone to errors, I would say. The unearned interest, the purchase, discounted expenses on the portfolio, and the interest accrual on the bills portfolio. Now, of course, we are seeing CBS given in most of the cases. But even then, again, like in an audit, as an audit procedure, I would suggest that you look into instances of unearned interest and interest accrual, and do a match check to ensure that. Now, what do we do with the interest rate? Now, obviously the interest
Anil
rate.
bhai, your voice is not very clear. I
Okay,
think is
I
there
think
some issue in your
I'll
internet?
just. Is it just happened?
Just happened a bit 10-15 seconds back. We've got a
Okay.
number of complaints also. Voice is not clear.
Okay. Should I go back to the earlier slide, or is it okay now?
Now it's much better. So if you could repeat the
Hello?
last slide, it would be good enough, I think.
No, is it? But is it?
Still some cracking of voice.
बंद करो. Please stop using the internet.
ताली तो सुनाई दे रही थी.
बंद करो. I'm trying to put off the internet use in my house. Probably that's the reason.
I
How is
think
it
now
now?
it's much better. Now you can start, sir.
Yeah, yeah. I think because of COVID, lots of Netflix happening. So maybe one of the reasons why. Is it okay now?
Yes, yes.
Okay. So in case there is something like I think I'll just go back to the slide earlier. There's not much we talked of in the earlier slide. We need to do a linear ratio analysis and identify abnormal variances. With respect to interest, what I was talking of is that I think we need to ensure check deep verification, hygiene check of the interest income more than as compared to the interest expenditure, because the risks uh, within an interest income in a bank are much more than the interest expenditure side. I also advise that with respect to the bills portfolio, both with respect to the unearned interest and the interest accrued, both of them are CDS driven. But wherever the bills portfolio is beyond the year end, where we have to reverse the unearned interest, I think as an audit procedure, I think we need to pick up a sample and do a manual check of that. Similarly, where the bills purchase or the date is over and it's been extended beyond that, I need to accrue the interest. So here also I can probably carry out a manual check of some this thing. Now, when we come to the interest income part, I think all of us are aware that it is when it comes to the term loan, because normally they are fixed and related to the MCLR or the base rate, whichever is being used by the particular borrower and the bank for that particular loan. The change whenever it happens during the year, the first exercise which all of us as auditors would require to do is identify the dates on which such interest rates were changed, the base rate or the MCLR were changed during the year, impacting the interest applicable on the borrowers. So obviously this gets changed automatically by the central server, and it would get automatically changed in the term loans. But when it comes to CCOD, since it's also related to the rating, so one would when you see the parameters in Finacle, it is normally it would say that MCLR plus 25 basis points, but that 25 basis points would probably not probably would be related to and would be dependent on the the rating of that particular borrower. So obviously that would make it subject to change. Now let's say an account got sanctioned around 1.5 years back, or probably lesser, and the interest rate has changed during the year, the rating has changed during the year, and it was when it was sanctioned, the parameters which were fed into the computer were probably the MCLR plus 25 basis points. But let's say as of date the MCLR of course gets changed, but in case the rating has changed over this period, then automatically it may require the interest applicable to be MCLR plus maybe 50 basis points or 75 basis points. So whoever is carrying out the audit of advances, which like we discussed yesterday, I would suggest would should be either the partner if he's already visiting the if he's visiting the branch, or else some senior person who understands the advances portfolio properly. So he would during the course of review of individual advances, I would suggest that he not only does this, but he also maps the interest rate which is being applied with the sanction letter, because the MCLR plus whatever basis points is to be added, that would be as per the sanction letter, right? Then some risks which I've put down here. One would be that the interest realized on NPAs has to be taken to income, except for one exception where the credits are not out of fresh or additional facilities. Now, in case like we discussed yesterday, the LCs and the BGs invoked, they get parked in a separate account. Some banks still do it. If they have parked it in a separate account, of course, for the purpose of IRAC classification, you would club it with the primary operating account. But then another check which you also need to ensure is the interest which is debited to this particular separate account which the bank is parked separately has to be as per the interest rate which is applicable to the main operating account, and it should not be as per the MCLR, etc. Similarly, the rate of interest in TOD accounts. Now, if there's a separate TOD account, now what is the interest which is being applied in such accounts? If TOD is part of the sanction, obviously it will be as per the sanction letter. Now, another check is in case the forward contract. Now, of course, you will have to look into the kind of accounting policy which the bank which you are doing, whether they are accounting for bank guarantee commission, etc., on cash basis. If they are doing it on cash basis, then of course, it would have no relevance, this check on the last bullet. But in case that bank is accounting for BG commission, etc., on accrual basis, then whatever is the unexpired portion, you would need to reverse that particular this thing. As part of an audit procedure, I would also advise you to manually test check the bank guarantee and the LC's commission, especially where the BGs and the LCs get extended. Now, what happens to the income in case the LCs and BGs are cancelled? Then whether we have refunded the income to the particular borrower, we would need to check. And again, this I would not advise you to pick up a large sample, but to mitigate this risk, to ensure that these kind of risks are not there at a general level in the branch you are doing, I would suggest that in case you are able to identify some such cases, please pick them up and do a manual check. In case the BG commission is being accounted for on accrual basis, then obviously, they would have a BG amortization account under the other liabilities. So when you're doing the balance sheet, other liabilities, you would find that unamortized BG commission there, and which, obviously, based on the period which expires, one would require to account for. Processing charges, generally, you are required to account for that from the renewal or the review date and not the due date, because there could be instances where the account has not been reviewed for maybe more than a year, but if I have inserted the parameter of a due date in that particular account in Pinnacle or the CBS software of that bank, then the processing charges would automatically get credited to the income account in spite of the account not being processed, which obviously would not be in the fitness of things. Another very important, the second bullet which I've highlighted here is, there are a number of borrowers where you would find that based on the goodwill they have, based on the kind of repayment history they have, and based on various other parameters, the banks have they would probably shoot out a sanction letter where they would give interest concessions. But when there is an interest concession, what we as auditors need to ensure is that these kind of concessions are given at account level and not customer level. So if a borrower has, let's say, 8 or 9 accounts, and if I, in the Finacle or the CBS software, I incorrectly or by erroneously mark the interest concession at a customer level, then although I intended to mark the concession only in the CCOD or the term loan, it would result in the concession going to the borrower across all accounts it has, obviously to the benefit of the borrower and to the discredit of the branch concerned. Legal expenses is another thing which, while you are scrutinizing the profit and loss account, a scrutiny of the legal expenses, of course, in case they are material, they can give you a certain information based on the scrutiny. And now, let's say you have a substantial amount of legal expenses being debited at the branch, and then when you make the lead sheet, when you scrutinize those accounts, you find that a number of fee is being paid to a few advocates. Now, when you talk to the law officer, you may find that there are a number of cases which probably require disclosure in the contingent liabilities. And together with this, you can also, in the course of discussion, probably come upon some cases where there has been a decree and where the NPA provision may have to be changed based on the decisions of this. Of course, it's purely subjective. It may or may not be relevant to your branch, but this is just a check which came to mind, which I thought would benefit all of you. Some risks which I've identified in respect when I'm reviewing the interest rates, which are a possibility, definitely not a general this thing. Like there is a possibility that interest rate may have been set at zero. Instead of putting the MCLR plus 25 basis points, I could have put it at zero. I could have, in case my CBS software allows, I may have put it at the periodicity of interest application at being other than monthly. I could, at the time of sanction, probably put the interest application date as if there is a moratorium in the interest application, in spite of there being no moratorium as per the sanction letter. Obviously, the fourth bullet is something I need to do a thorough exercise, compare the interest rate as per the sanction letter with what has been set into the CBS software. The collection flag has to be obviously set at yes. So if it is not being set at no, then this could be a risk. Yeah. And then, the pegging flag is there in the CBS software where, the interest gets pegged at a level. So unless the interest is pegged, you should ensure that the pegging flag is not marked. Then one important clinical report which is generated and is available for all of us is the interest failure report. So as soon as you reach the branch, I think the interest failure report is something which you need to ask the branch official concerned to generate for you. Review that interest failure report, document that as part of your permanent or the general audit file, and ensure that there are no interest failures in any account where interest had to be debited in that particular account. I get on to the audit report, the LFAR, just a few slides. Obviously we need to have use our letterheads. Kindly avoid pre-printed audit reports because you would not be able to change it unless you are doing one of the banks where there is an online report which has to be issued. You may have to inform the consolidating central statutory auditor, because your report would be generally addressed to him about the provisions which have not been made at the branch level and various other matters. Now, the accounting policies of the banks are generally not shared with the the branch auditors in most of the banks. So in case you do not have the branch significant accounting policies for the current year, in any bank you are doing, in case there are some banks which are still not sharing the current year's significant accounting policies, then obviously the AS1 would be one matter which would need to be qualified, and then the other accounting standards compliance which you would require to state in your audit report that these would have to be complied with at the HO level would be 15, 17, 18, 22, 28, 29. I think most of us are already, in most banks, there are statements with respect to the AS 29. SA 701, I think we already discussed yesterday. I think, even as per the guidance note 2020 of the Institute, the CAM is not applicable for branch auditors. There is, while issuing the audit report, we generally say that the transactions of the branch auditors have been within the powers of the bank. I think this is one thing which we need to ponder about, and just in case you do find some material cases like let's say there are BGs, LCs where the higher authorities have fixed a particular margin for them, uh, let's say a 20% margin or a 50% margin, and then the branch is allowing the BGs, LCs to be opened at 5% or 10% margin. To my mind, this would be allowing transactions by the branch official which are beyond the powers of the manager. And obviously the next thought which comes to mind is whether we would be correct in writing that line in the audit report without giving that exception. And of course I would again go on to say that this has to be done only when it is material as per the SA 320 which we already discussed yesterday. LFAR and the new certificates, obviously, I think this is an old point that any PNPA or an MOC matter which you do not want to actually issue an MOC because whatever pressures you may have at the branch or administrative level, please do not report it in the LFAR or the tax audit report. You need to be satisfied, or as an auditor, as a strong auditor, do issue the MOC. And in case you have any problem, I would definitely advise you to take help of the central statutory auditor, so that you are able to do what you are required to do as a statutory auditor of that particular branch. Ghosh Jilani, of course, oft repeated, avoid yes, no, not applicable replies. Do read the questions concerned and reply only where which are relevant, and do not allow any answer to be there are some banks where the answers are already fixed, and most of the auditors are only required to sign. In case anything like this is done, you need to with respect to the Ghosh Jilani, either shoot out a separate report to the central statutory auditor together with copies to the management, or in case you are allowed to, then probably make it part of the main audit report in the other matters. ALM, of course, you'll never be able to verify the buckets because of various inherent limitations. So in case the you are signing it without verifying the buckets, then again here, in case the statement allows qualification, please do it. But nowadays, I think most of the banks in their financial statements, the bank's financial statements, they are generally saying not verified by the auditors and certified by the and is as certified by the management. So if that is the case, obviously you may have an instance where the ALM statement may not be required to be signed by you as the branch auditor. But in case it is required, please ensure that you qualify this, because I do not see any bank which will give you the details of the individual borrower wise asset liability maturity. All other certificates, in fact, whenever you sign them, please ensure verification at and documentation based on which you are certifying that. Do not make it a sign off exercise. Do not make it an exercise where we do this exercise of finding out which certificates are to be signed at the last day when we are signing off the financial statements. These are all important, true, and correct certificates which we need to uh, certify. There are confusions generally because I keep getting this oft-repeated question about, which are the advances where the annexure to the LFR is to be attached. Now, let me clarify that, it is for branches dealing in large advances, it has to be for all advances with outstanding balances of 2 crores and above. Do not make this advance in your branch in case the account is only around 50 lakhs, 10 lakhs, 1 cr, or anything less than 2 cr and above. Of course, B and C, B is Annexure B is restricted to specialized branches dealing in foreign exchange transactions, and C is only with respect to the questionnaire like Annexure A, which is applicable to branches with advances in excess of 100 crores. It is not applicable to any other this thing. See, one or two UDIN's FAQs. One, there is a clarification that whether UDIN is to be taken for all certificates, as there are a bulk of certificates there. I think it has already been clarified since it is one assignment. You need to generate only one UDIN for the financial statements, your audit report, and also all the certificates you sign. LFAR again is part of the same assignment, hence only one UDIN will suffice. For tax audit, it has been clarified that as of now, very few banks are getting the tax audit signed by the branch auditor because of the tedious issues and other considerations. So probably this may not be required, but if you are signing the tax audit report, you would require to generate a separate UDIN. Now comes to, I'll take around 10 minutes before, or probably before we take the questions up to this stage. Now, capital adequacy, like I said, we generally is a statement which, one assumes or that mapping it with the financial statements is all we are required to do. As an information, I need to tell you that, most of the banks' capital adequacy is not through the main CBS software. In a bank, like you would also see while doing the IREC norms, there are a number of surround softwares, as I would call it. So, these are softwares which, work around the Finacle, and then they are mapped with the main Finacle software. But then, the entry, the processing, etc., is done separately and then ensured. Now, let's say, I'm doing a capital adequacy statement. I would generate the statement from whichever surround software I'm using, and then ensure that it is mapped with the financial statement through which I'm generating the probably the CBS software. Even the financial statements are generally generated by another surround software. So, maybe that is the reason why we need to map it with Finacle. So, in case of a branch, there are three aspects to a capital adequacy. Primarily, if you see, it is about mapping the capital of the bank with respect with the risk-weighted assets, and the risk-weighted assets generally would be on the asset side. So, with respect to a capital adequacy, the market and the operational risk, they are not related to branch level verification, but the credit is to be verified at the branch level. Now, let us look over the next two slides. What are the kind of checks we can put in at the branch level? Obviously, the first thing is whether the advances are mapping with the risk-weighted asset statement Basel II, which you would all get to verify. Now, whether the correct asset code classification has been used in the risk-weighted asset. Now, why do I ask this to verify? Because, again, this is a mapping, because this is, the IREC statement is again a surround software, and the risk weighted asset is again a surround software. So I need to map both the asset code, which is as per the IRAC norms, or maybe generated mapped with the Finacle also, with the risk weighted asset working sheet. Now the third bullet is whether the correct risk weights have been assigned to the exposure according to the claim categories. Now if you refer to the master circular I referred to earlier, now there is a table which actually gives you a whole lot of number of separate heads, which like you need to classify accounts as the consumer credit, commercial real estate, CRE, residential housing, domestic public sector. So I need to classify this. So when I am reviewing the advances, what I need to ensure is whether as per that master circular, whether the claim categories is correct. Now what is the difference if the claim categories is incorrect? Now let's say it is a commercial real estate, but it is actually a commercial real estate residential housing. Now both of them would have a different weight. Now as soon as the risk weight is different, the risk weighted asset outer figure would change. Then comes to the undrawn amount. Whenever you're checking a term loan account, you also are required to give the undrawn amount in the CRAR statement. Now, undrawn amount generally, would is not the amount that is the sanction limit minus the amount I have disbursed. No. Now, let us say there is a term loan where I'm disbursing the term loan in two stages. 10 lakhs in the first stage, once I've completed X operation, and 50 lakhs in the second stage. So a total term loan of 60 lakhs. Now, in that case, if I have just disbursed 5 lakhs, normal course, what you would say is that 60 minus 5, 55 is the undrawn. That would be an incorrect statement, because and then it would result in a higher risk weighted asset going. So, what I am required to do as per the circular, the master circular on CRAR, is I need to calculate the undrawn amount from the first tranche, which is 10 minus 5. 5 is the only amount which I should show as undrawn and not 55. Similarly, in a CCOD account, generally in a Finacle, the unconditional cancelable clause, if it's wrongly marked as yes instead of no, if it is marked as no, the undrawn amount of this thing would be the sanction limit minus the balance outstanding, which will be the undrawn amount. But if it is marked as yes, probably it'll take the entire sanction limit. I'm not very sure about what amount it would take, but definitely it would not be as per the master circular. Again, in the CRAR statement, you would find that the guarantee margins and the collaterals, whether they have been linked in the master parameters in Finacle, because if they have been correctly linked, then I would get a correct outer figure based on which I would calculate the risk weighted asset. And these are figures, when you actually look at the statement of CRAR, it's not as if it's a very complicated thing. It's primarily what you've already done in your advances review, what you've already done in your guarantees review, and what you've done already in your other advances and financial statements review. Then you are also required to check whether the loan to value ratio in respect of obviously housing loans is correctly fed as per the sanction letter or the actual security value. This you would require to do when you're checking the CRAR. Whether, of course, like we earlier said, the NPA flags are correct in the risk weighted assets, and the provision percentage is correct as per the. So you'll have to map the CRAR with the IRAC statement separately. And of course, the most important would be, wherever rating is compulsory, whether the account has been correctly shown as per the rating which is available as of date. See, if you put it at underrated, you will have a separate risk to it, and obviously a separate risk weighted asset. And if you put a wrong rating of AA, whereas probably it is double B or D, then you will again have a different risk to it. So I think it's a the easiest way of doing it is ask the branch to give you the risk rate. If it's an external rating, you can go to the site of the rating agency, put in the name, you'll get the the rating of that particular account, and map it with to what the rating the bank has used in the CRAR statement. So, this is one exercise. As of now, I think, you'll have to, of course, check the bank guidelines. But as of now, the risk rating, external rating is compulsory wherever the exposure is more than 25 crore. So these are, a few checks which, to my mind, were very important in a CRAR. Of course, whenever you do it, like I said yesterday, in case you do face any issue, you can always, come back to us, to me, and we can discuss that to, help you do the CRAR statement in a better way. I think we are at 4:40, Manu. I can probably, stop for the questions, and then maybe we can take up the IRAC norms tomorrow afresh.
Okay, sir, we start with a question from our very Vinay Jain, sir.
Does non-submission of stock statements for month from June to January to will qualify as COVID issue, and how will banks apply margin for calculating this thing? Non-submission of stock statements for months from January, even otherwise, as per the IRAC norms, when you see tomorrow, they would not result in classifying those accounts as NPA. So I'm not able to, relate how would this matter be relevant to the COVID circular. But then I think, uh, probably you can discuss it over phone, or maybe clarify your question a little more. Praveenji, bank reversed interest for the last 5 years of some of the accounts at HO, which was not classified as NPA. Consequently, the income of the current year decreased, whether it is correct as per the accounting policy. Now, if this is a specific case where, they have reversed it for the last 5 years and not, in spite of the account not being classified as NPA, I am not able to understand under which circumstances this would have been done. Probably, it can only happen if it is, converted into an FITL and restructured under one of the restructuring this thing. But even then, unless it is in the 7 June 2019 circular or an MSME, I cannot think of any instances where this can be done, Praveenji. CM Makrand Nagar, he's saying, what about the GST provision on legal expenses? I think, GST, I'll leave it. Makrand, I'm not an expert on GST. Let's leave the GST part to, normal this thing, because now it is a very settled kind of environment in all the banks in respect of GST. The first year was an issue, but I think now there are no longer issues. LFR, whether there is any autonomy given to banks in terms of fixing threshold for audit of non-corporate entity. As of now, no. Vijayji, as of now, no. I think, the question keeps still is the same. Pradeep Jainji, please guide about certifying Ghosh and Jilani committee report questionnaire. Okay. Pradeep, I think, when you're checking the Ghosh and Jilani committee report, when you're answering, if you've gone through it in detail, they are primarily questions which are related to, general operations of the bank. So when you read the question on the left-hand side, you may find that, the question which has already been pre-printed in your bank is probably not relevant, or it cannot happen. Like, you still have questions of the dot matrix printer and various other this thing, which, actually you cannot answer is yes, no, or this thing. So what I was suggesting is that, please you reconfirm that, whatever answers one is giving is as per the question on the left hand side. And secondly, wherever a more detailed question is to be answered, please do that instead of just saying yes, no, not applicable. When you go through that Ghosh and Jilani committee report, you will find that those three answers do not are not sufficient to just answer the detailed questions on the Ghosh, Jilani and committee report. If branches has not prepared the sheet for large advances, what is the responsibility? Amit Agarwal ji, I think, like I said yesterday, that, the first thing you need to do as soon as you receive the appointment letter is to obviously talk to the branch manager, tell him that, what are the things you would require, shoot out a mail and highlighting and informing him as to what exactly you would require. And this being a very important document which you would need, I think you immediately talk to him and tell him that this is what would be required by you during the course of your audit procedure. Gaurav Agrawal ji, dear sir, please guide. Is there any system in the branch? I could not. Manu, the earlier question.
Sorry, sir. Sorry, just a second.
Dear sir, please guide. Is there any system in the branch to see all non-fund based limits like LCBG sanctioned in CBS, or generally it is maintained in a manner? No, they're all Finacle routed. I think you can definitely see that. If you want the transaction code, I'll send it to you through mail. You can write an email to me. Subodh Joshi ji, sir, can you explain once again the effect of recent guidelines or decisions on NPA status of banks? I think, if you are referring to the 27th March 2020, I'll just quickly in 5 minutes tell you that, what the RBI 27th March circular is given is that it's given a moratorium for all installments from March, April and May in respect of term loans, all term loans. And in respect of CCOD, what they've done is that, for interest for the period for March, April and May is deferred for the period post 31st May. So my issue, which I had highlighted, was only that, any term loan which where the interest and principal as of 31st December 2019 has not been paid up to 31st March 2020 in the normal course is to be classified as an NPA. So I do not see any relaxation in that. So in case, any term loan where the principal and interest has not been recovered up to the year end, you would have to classify it as an NPA as of date. And with respect to the CCOD, obviously, what I had said was whether the credits are enough to cover the interest debited. So the interest debited, you would have to consider only the January, February part and not the March.
May I please supplement it, please?
Yes, sir.
Neil. In fact, this 27th March circular is just a relaxation to the borrowers. Their installments or their interest repayments have been, you can say, some moratorium have been provided, or some deferment has been given. So far, RBI has not come with any COVID-19 related relaxation for the banks. So far, the IRAC norms provisioning or the recognition is concerned. Probably it will come, but this circular does not affect the IRAC norm provisioning and the recognition. It is only for the customers and the borrowers. Please continue, Anil.
Yes, yeah. Prashant Mishra has asked. I'm not able to, Okay, FITL will be considered secured or unsecured for provisioning. I think, Prashant ji, I think you would be aware that, FITL portion is primarily related to all the income which is reversed. So obviously, since I have the credit on the other liability side, it is obviously 100% provided. There's no, there's nothing to be provided further on that. Sukant Roy, how change in nature of BG will be dealt with in MOC part? Will MOC relating to CRAR and Basel will be done? Definitely, in case, the in the other part of the MOC, you would first have to change the classification of the bank guarantee from performance to financial or vice versa, and also pass the consequential MOC with respect to the capital adequacy. Definitely. Praveen Agarwal ji, in case CCOD and the credit submission during January to March cover the interest debited but does not cover the processing fees and insurance charges debited, whether account is NPA. I think, as of now, if you look at the IRAC Master Circular of July 1, 2015, it talks of only the whether the interest debited is covered by the credits during this period and not anything else. Of course, we can discuss this further tomorrow also. What is our liability in case of GST in case of expense? Again, because I think it's a pure GST matter. It will not, it's primarily you need to ensure that the GST returns are filed. They are covering. But like I said, all the CBS softwares which are there as of date, they have, settled in respect of the GST, because more than a year has passed. Yeah, at least this is based on verifications and reports from all the banks. Dinesh Yadav and company, ratification of the act over exhausting the power of branch by superior authority, whether required to be reported. If it is already ratified, obviously, it is within the powers of the branch manager, then you do not need to report. What I was referring to and what I wanted you to ponder was, in cases where it has not been ratified and you observe this, obviously, suppose you observe this during the course of the audit and you are issuing the audit report immediately, even if the audit, the ratification happens subsequently, then that would be a case which would happen post the audit report you issue. So till the time you are issuing the audit report, in case this ratification has not happened, obviously you would required to report it with an exception. Any change in the LFR this year? Not as of now. In case we are reporting MOC date of earlier year and directly advising as D1 whether interest of earlier years, yeah, definitely. You have to reverse it from the date you issue the MOC. You reverse all the interest and uncollected charges, and classify the account whether as D1, D2, substandard based on the period since it was an NPA.
All the
Shamji,
unrealized, all the unrealized interest has to be reversed in any case.
yes, definitely. Shamji Gupta has asked me to explain the FITL again. Shamji, I'll explain it to you, to whatever extent I can. What I was referring to is, now let's say there is an account, an advances account, which is under stress, and the the branch decides to restructure that under one of the schemes. Now, when it restructures that account, what it says is that the uncollected or the overdue interest, as part of the restructuring exercise or the resolution plan, they convert that the uncollected interest, they carve it out of the main balance into an FITL account. So it would be an FITL XYZ borrower and parked under the advances part. Now, since it is an uncollected interest, as per the auditor and as per prudence, you need to reverse it. So I do not reverse it. What I do is I reverse the interest income by debiting the income in the profit loss and crediting FITL other liabilities account. So the effect is I have an FITL account in the advances side, a debit side, and an equal amount of FITL under the other liabilities. Impact is zero, but then that because I have reversed it. Subsequently, now suppose the next year you realize 10 lakhs under the FITL account. Now, if he is paid 10 lakh amount, then the FITL on the advances side will come down from 100 lakhs to 90 lakhs. But the FITL on the other liability side is still 100 lakhs. That is because the 10 lakhs you have received, it has to be accounted for as income based on receipt. So what you do is you credit income and debit the other liabilities FITL account. So again, you have a matching concept on the advances and the FITL. Sukant Roy,
So,
mostly bank.
Anil bhai, this is the last question, thankfully for you.
Okay. No, it's not a. Sukant Roy says mostly banks are providing reports account wise. They become operative to inoperative and providing KYC pending details. Uh,
Sorry.
uh, Details customer ID wise and not providing account, no link with all customer ID. How to mitigate the risk? Sukant, I'm not clear about what exactly your question is. I think maybe you can take it up tomorrow, or you can call me up.
So, Anil bhai, again, as usual, a very nice presentation, and I think everybody who joined really enjoyed. And it was a wonderful session, and we'll have this session again, part 3 tomorrow at the same time, 3 o'clock to roughly around about 4:30, followed by the questions. And I think you will not be able to complete it tomorrow, so there's an extension of 1 day which you would require.
I think maybe, but in case yeah, of course, if we need to do the lead sheet and the data, this thing, definitely we would require, at least half an hour, 45 minutes. So not possible tomorrow.
Okay, so we'll plan it. We'll plan the fourth session maybe on Sunday or Monday. We'll just plan it out
Sure.
tomorrow and announce it tomorrow. And over
Right.
to Akshay bhai.
Yeah, I've already dealt with a certain issue which arose during the discussions, and nothing much to add as of now. But we all will have to wait for some kind of relaxation in the IRAC norms. Probably when the time we go to the branch audits, something should come from RBI. So let us wait for that. And for the time being, there's nothing much. But tomorrow, since we are dealing IRAC norms, well, we will discuss that issue also. That how this circular, how the moratorium, and how the stock valuations or the security valuations, etc., would be affected due to COVID-19 impact. So for today, thank you all, and thank you Anil, thank you Manu, and of course Gyanji, who is taking lead on this. Thank you so much, everybody. Please.
Thank you, Akshay bhai. And now over to Gyan.
ज्ञान अनम्यूट करिए अपना.
मैंने कर दिया सर. ओके.
थैंक यू ऑल. हमेशा की तरह अनिल सक्सेना सर ने बहुत अच्छा प्रेजेंटेशन आज भी दिया, और जिससे हम सभी को, न केवल कानपुर के लोगों को, बल्कि आई थिंक मनु भैया ऑल ओवर इंडिया से काफी लोग जुड़े हुए हैं, तो उनको सबको फायदा मिला है. और हम लोग फिर से कल इस बैंक.
मनु, आज कितने लोग रहे?
Yeah, there were roughly around about 220 people connected at most of the time. 200 plus थे आज.
Okay, good.
Thank you.
So once again, thanking everybody and wishing you a nice evening and a good session tomorrow again. Thanks to all.
And don't do anything that you come out of lockdown and go in the lockup. Take care.
Okay. Bye.
Bye.